Hello everyone, welcome to the market opening bell for Friday, May 29th, your 10-minute guide to the stock market. The Hang Seng Index opened 97 points lower and saw selling pressure intensify, falling as much as 600 points at one point and briefly losing the 25,000 level, with the intraday low at 24,727. It later recovered some losses in the afternoon, closing at 25,006 points, down 322 points or 1.3%. Total turnover for the day was $356.3 billion. The Hang Seng Tech Index closed at 4,888, down 18 points or 0.4%. The A-share index closed at 8,364, down 98 points or 1.2%. Southbound Stock Connect recorded net buying of 7.609 billion Hong Kong dollars in Hong Kong stocks. Among them, net buyers included SMIC at 41.74 billion, POPMart 11.21 billion, Hua Hong Semiconductor 8.11 billion, Meituan 6.72 billion, Sino 5.16 billion, Dongyue 4.54 billion, and Xpeng 3.93 billion. Net sellers included Alibaba at 13.03 billion, Xiaomi 5.96 billion, and Yangtze Optical Fiber and Cable 2.12 billion. According to statistics, Southbound funds have net bought SMIC for 9 consecutive days, totaling $14.313 billion. They have net sold Alibaba for 6 consecutive days, totaling $8.258 billion. Net sold Tencent for 5 consecutive days, totaling $5.52 billion, and net sold Yangtze Optical Fiber and Cable for 5 consecutive days, totaling $1.67 billion. After yesterday's sharp decline, the Hang Seng Index recovered to 25,000-point level. It is expected to stage a short-term rebound with initial resistance at 25,250 points and the next resistance level at 25,500 points. The 3 major A-share indexes opened 0.1% to 0.3% lower than reverse gains in the afternoon, closing up between 0.1% and nearly 2%. The Shanghai Composite Index closed at 4,098 points, up 4 points or 0.1%. The Shenzhen Component Index rose 125 points or 0.8% to 15,861. The Chinex Index gained 79 points or 2% to 4,125. Total turnover in Shanghai and Shenzhen markets reached 2.97 trillion yuan. The onshore renminbi exchange rate against the US dollar was fixed at 6.824, up 51 pips from the previous day. Changxin Technology Star Market IPO has been approved by the listing committee. The company plans to raise 29.5 billion yuan, which would make it the largest A-share IPO this year. SMIC closed at $88.25, up 3.6%. Hua Hong Semiconductor closed at $170, up 11.6%. Xpeng Group rose 5.6% against the broader market. According to media reports, Xpeng chairman He Xiaopeng stated in an interview that the company has made a major strategic shift in its autonomous driving technology. He believes that the Frankenstein approach, combining software engineering and AI algorithms, cannot achieve true driverless capability. Therefore, the company decisively halted the old system last year after investing billions and instead bet on a brand new physical AI architecture. He Xiaopeng expects this new path to achieve L4 level autonomous driving within 18 to 24 months, around the end of 2027. He also emphasized that autonomous driving is only one key application of physical AI. The company will use this as a foundation with vehicles, robotics, and global business, serving as the 3 major growth curves for the next decade. Additionally, Xpeng recently held a mass production mobilization meeting for its robots, where He Xiaopeng outlined key timelines. Humanoid robot mass production by the end of 2026 with deployment as sales guides in Xpeng offline stores expected in the first quarter of 2027. He stressed that Xpeng's robots are fully self-developed, from chips to operating systems and from joints to dexterous hands, making it the only domestic company with full-stack self-developed robotics. The high initial investment is expected to deliver higher quality, better aesthetics, and more comprehensive capabilities. After the market close, Xpeng released its first quarter results ended March 2026. The company is at the intersection of industry off-season and strategic transformation. Total revenue for the quarter was 13.034 billion yuan, down 17.6% year-on-year due to overall market slowdown and price wars. Net loss widened to 1.784 billion yuan, however supported by technology licensing and physical AI. Its gross margin showed strong resilience, rising 5 percentage points year-on-year to 20.6%. Vehicle gross margin increased 1.6 percentage points to 12.1%. Li Auto also announced its first quarter results ended March 31st, 2026. The performance was severely hit by model transition and lower average selling prices. Net loss attributable to ordinary shareholders was 2.29 billion yuan, compared with a net profit of 650 million yuan in the same period last year and 6.519 million yuan in the previous quarter. Earnings per share were 1.13 yuan. Total revenue was 22.983 billion yuan, down 11.4% year-on-year and 20.1% quarter-on-quarter. The company expects Q2 vehicle deliveries of 95,000 to 100,000 units, down 14.5% to 10% year-on-year. Revenue is projected at 24.1 billion to 25.4 billion yuan, down 20.2% to 16% year-on-year. Overall gross margin plunged from 20.5% a year ago to 7.9%, while vehicle gross margin drops sharply from 19.8% to 6.1%. Transition measures for new models, product cycle changes, and supply chain raw material fluctuations have severely squeezed profit margins per vehicle. NIO rose 6.3%. Its new intelligent electric executive flagship SUV, the ES9, was officially launched with 3 variants: Executive Luxury, Executive Signature, and Horizon Special Edition, priced between 498,000 yuan and 628,000 yuan. A BAS battery rental option is also available, with prices ranging from 390,000 to 520,000 yuan. The ES9's core strengths include superior space from its extra-large dimensions, a 900-volt high-voltage platform, and intelligent driving capabilities, powered by the new 5nm Shenji NX9031 chip. REIT released its full-year results for the year ended March 31st, 2026, showing resilience in overseas markets despite rental pressure in Hong Kong and mainland China, along with active cost control. Affected by headwinds in the Hong Kong and mainland retail markets, revenue and net property income fell 2% and 3.7% to $13.938 billion and $10.23 billion respectively, mainly due to negative rental reversion rates in Hong Kong and mainland China operations. Loss attributable to unit holders before transactions with unit holders narrowed from $8.863 billion to $7.397 billion, with basic loss per unit at $2.86. Distributable amount decreased 6.4% to 6.577 billion yuan, Hong Kong dollars. The final distribution was 126.73 Hong Kong cents per unit, bringing full-year DPU to 253.61 cents, down 6.9% year-on-year. Hong Kong portfolio revenue and net property income declined 3% and 4.6% respectively due to negative rental reversions and higher operating costs. As of March 31st, 2026, retail portfolio occupancy remained high at 97.8%, supported by resilient tenant mix and stable demand from daily necessity retailers. Average monthly rent per square foot fell from $63.3 to $60.1. Full-year rental reversion for the portfolio was minus 8.2%. For the mainland China portfolio, total revenue and net property income declined 5.1% and 5.8% respectively due to negative rental reversions. After translation to Hong Kong dollars, both fell 3%. Occupancy in mainland China retail property stood at 96.6%, with rental reversion at minus 14.3%. Total portfolio valuation decreased 4.1% to 216.489 billion Hong Kong dollars. The decline in fair value was mainly due to lower market rents in Hong Kong and mainland China, while Singapore and Australia markets remained relatively strong. Net asset value attributable to shareholders fell 8.2% to 150.096 billion Hong Kong dollars, with NAV per unit down 8.8% to $57.75. Net debt ratio raised from 21.5% to 23.9%, primarily due to lower property valuations. Average borrowing costs further decreased from 3.58% to 3.44%. Creality 3D Technology, stock code 3388, which will be listed today, traded at $30.24 in the grey market session yesterday on Philip Mart, representing a 60.9% premium or $11.44 above the listing price. Excluding fees, each bought lot of 150 shares would yield a paper profit of $1.716. U.S. stocks continued their record-breaking rally after reports emerged that the U.S. and Iran had reached a preliminary peace agreement, while the market also digested the latest macroeconomic data. The fear gauge VIX index fell 0.55 points or 3.4% to 15.74. The Nasdaq rose 242 points or 0.9% to 26,917. The S&P 500 gained 43 points or 0.6% to 7,563. marking its third consecutive day of record closing highs. The Dow Jones rose 24 points or 0.1% to 50,669, recording closing highs for 2 straight days. The Nasdaq Golden Dragon China Index, which tracks Chinese stocks listed in the U.S., fell 31 points or 0.5% to close at 6,586. Of the 11 sectors, 6 closed lower, with utilities leading the decliners and healthcare leading the gainers. Dollar Tree raised its full-year earnings guidance and reported first-quarter results that beat market expectations. Its share price surged nearly 18%, making it the best performer in the S&P 500. Best Buy reported first-quarter results ended May 2nd that exceeded expectations and maintained its full-year guidance, driving its stock price up sharply by 15.8%. Snowflake surged 36% after the cloud data platform raised its full-year product revenue forecast and reported first-quarter results better than expected. After the market closed on Wednesday. The company also reached a $6 billion infrastructure spending agreement with Amazon Web Services. Dell Technologies announced record first quarter results ended May 1st that beat expectations, driven by a surge in demand for AI-optimized servers. Adjusted earnings per share rose to $4.86 up from $1.55 a year earlier and well above the expected $2.96. Revenue for the quarter jumped 88% year-on-year to $43.84 billion, beating market expectations of $35.74 billion. The company raised its fiscal 2027 guidance. It now expects full-year non-GAAP earnings per share to grow 74% year-on-year at the midpoint to $17.9. Previously was $12.9. And revenue to reach $165 to $169 billion, with the midpoint up 47% year-on-year. Previously was between $138 to $142 billion. The market had expected full-year adjusted earnings per share of $13.12 and revenue of $143.19 billion. Dell shares rose 19% in after-hours trading. The stock is up 152% year-to-date. On U.S. economic data, U.S. first quarter GDP was revised down to 1.6% from the initial up 2% due to slower consumer spending growth. The market had expected no revision. The Fed estimate for Q1 GDP will be released on June 25th. U.S. April PCE price index rose 3.8% year-on-year, up from 3.5% in March, and the highest reading since May 2023, in line with expectations. Core PCE, excluding food and energy, rose to 3.3% from 3.2% in March, also as expected. April personal income was flat after a 0.5% rise in March, missing the expected 0.4% increase. Consumer spending growth slowed from 1% in March to 0.5% in April amid high gasoline prices. Real PCE rose 0.1% month-on-month, following a 0.3% gain the previous month. New orders for durable goods rose 7.9% in April, significantly higher than the 1.3% gain in March and well above the expected 4% rise. Excluding transportation orders, which surged 21.5%, new orders rose 1.1% month-on-month, matching March and beating the expected 0.5% increase. New home sales fell to a seasonally adjusted annual rate of 622,000 in April, lower than the downwardly revised 663,000 in March and well below expectations of 660,000. New home sales were down 11.3% year-on-year. Supply of new homes for sale rose 1.7% to 489,000 units, but was still down 2.2% year-on-year. Initial jobless claims for the week ending May 23rd rose to 215,000 from the upwardly revised 210,000 the previous week, higher than the expected 211,000. Our stock pick today is PATEO Connect Technology, stock code 2889. PATEO Connect Technology is primarily engaged in intelligent cockpits and connected vehicle services. It's an AI technology-driven provider of integrated automotive and mobile terminal solutions, as well as an ecosystem builder that combines software, hardware, chips, and cloud services. According to CIC, the group is one of the earliest companies to develop intelligent cockpit solutions, placing it ahead of most peers. Unlike other intelligent cockpit solution providers that mainly focus on hardware, PATEO differentiates itself by offering comprehensive solutions that integrate software, hardware, and cloud services. This model enables the group to provide highly customized, all-in-one solutions to meet clients' diverse needs. As a leading intelligent cockpit solution provider, the group focuses on the R&D, production and delivery of high-end flagship products while driving volume growth in mid to low-end products. In the high-end market, PATEO concentrates on the Snapdragon 8295, Snapdragon 8397 and Kirin 9610A core platforms. It is one of the few suppliers in the industry capable of providing intelligent cockpit solutions based on both major platforms. In the mid to low-end market, the group continues to expand its market share and consolidate its competitive advantages. In the first quarter of 2026, the group achieved year-on-year revenue growth of over 100% with a significant improvement in operational profit margin. The main reasons were: 1. The success of its high-end intelligent cockpit strategy with strong growth in high-end solutions. 2. Increased contribution from overseas markets as aftermarket intelligent cockpit projects for internationally renowned luxury brands began global deliveries. 3. Expansion into AI applications and services, with AI software and cloud-based intelligence services contributing new growth. In terms of business execution and strategic positioning, the group has further strengthened its market leadership in AI-powered and high-end intelligent cockpit solutions. Its high-end flagship Snapdragon 8295 platform products continue to see strong volume growth among domestic OEMs. At the same time, cooperation on intelligent cockpit solutions based on the Kirin 9610A high-end platform has deepened with rapidly growing downstream demand. With the mass production and delivery of Qualcomm's next generation 8397, 8797 platforms and the launch of new Harmony's new model vehicle, the market penetration of AI large models in vehicle cockpits is expected to continue rising. The group is well positioned to benefit from the industry dividend of both higher volumes and higher pricing in the high-end intelligent cockpit segment. Recommendation: buying price $220, target price $245, stop loss $208. I do not hold the above stock.